So with members voluntary liquidation then, which really we should call solvent liquidation because it's only available in a situation where there are sufficient assets to pay all debts. I think it's within 12 months. The typical scenario with that, I suppose, is where a limited company has been used to achieve a particular project or a particular scope of business, and it's come to the end of that project, and the business owner's looking to then maximise from a tax point of view what they can get from the business by way of distribution back of the money that's surplus. What's the sort of classic scenario there?
I think the classic scenario is probably the retirement scenario, where an individual or a number of individuals have successfully run the business. They now reach the point where they either want to exit the industry or retire, and they've got an offer either for the company or its business and assets of a substantial amount of money.
Yes.
Obviously, they want to keep as much of that as they can.
Yes.
If they were to distribute it to themselves as dividends for their shareholding, then they'd be taxed at income tax rates, which at the highest rates are sort of 45%.
Yes.
Whereas if it's a capital distribution, which can be achieved by doing the solvent liquidation, then it may well be eligible for entrepreneurs relief and taxed at 10%.
Yeah, and that can only be done by a licensed insolvency practitioner, I gather.
Yes, if the distribution is more than 25,000, then the revenue will insist for them to treat it as a capital distribution. It needs to go through a solvent liquidation, and that means that it needs to be done by an insolvency practitioner.
Right, but are there any little pitfalls which the revenue can pick up to challenge the entrepreneur's relief?
Yeah, I mean, it is a good tool, but it's not without a few pitfalls. So it's best if you plan this exit early, such that it's best if there's a prevention from using it if you return to that industry within 2 years, really, in any shape or form.
Right.
Employee or owner,
right.
or consultant even.
Yeah.
And there's potentially sort of restrictions on if you're carrying excess cash for too long in the business over its working capital. Then again, the revenue might seek to disallow that proportion.
Because that's investment income rather than trading income from that trade.
So once again, you need to probably do some planning around that to maximise the outcome.
And not have sat on a large amount of cash in an investment bank account for the last so many years.
That's right. So it's as well that you talk to us early, and and your accountant, and we'll look to ways to maximise your exit from that situation.
Great. Thanks.